Good day, my name is Tumeronik Tupe and I'm with my colleagues.
Frank Mokok.
Let's ask about. We will be discussing the fraud within the accounting and finance profession. And this presentation applies to the CIMA Code of Ethics, identifies ethical threats that hinders compliance, uses real-life scenarios to illustrate fraud risks, and proposes mitigation strategies grounded in ethical and behavioral theories such as social credit theory, deontological ethics, virtue ethics, and utilitarianism. Understanding fraud in accounting and finance profession. Accounting fraud is an intentional manipulation of financial statements which are done to create an illusion about the company's wealth. Fraud threatens public trust and credibility of the accounting profession. Professional accountants serve as the primary defense against these threats, acting as financial gatekeepers to detect, prevent, and respond to unethical behavior.
Conceptual framework. Conceptual framework approach of CIMA Code of Ethics for professional accountants. Require professional accountants to identify, evaluate, address threats to adhere to foundational code of ethics. It's all about identifying threats, evaluating, and addressing the threats. It was published by CIMA and it consists of professional behavior, objectivity, integrity, confidentiality, and professional competence and due care. And this is principle-based approach that is used by accountants to deal with ethical issues in the organization and how they can conduct themselves as professionals. First principle is professional behavior. This principle requires professional accountants to conduct themselves appropriately both in the workplace and in society to protect professional reputation through action, attitude, or behavior. So this is about how the accountants conduct themselves in working environments and outside the working environment and in the social platforms such as Facebook and the internet. They should be cautious on how they conduct themselves in these areas I just mentioned, because any misconduct such as criminal offenses or abuse of partners, it may ruin their reputation as accountants and they may lose their jobs. Objectivity is avoiding undermining professional standards due to pressures, influence of judgment, bias, and competing interests. So this is all about individuality of an accountant when exercising their roles of being an accountant in the organizations. Accountants, this principle encourages accountants to behave according to the judgment based on the knowledge and skills of accounting. Integrity, it involves honesty, fair dealings, compliance with ethical procedural standards, upholding client privacy, and refusal to submit to client pressures. Integrity is all about knowing between the wrong and the good as a professional accountant and actually picking the right actions even when you are faced with conflict of interest in the organization. It's doing the right thing all the time, even when the senior management tell you to manipulate the financial statements in such a way that they show an image of what is not really happening in the organization. And confidentiality, it encompasses a set of rules that restrict access to and usage of specific form of information. As you know, accountants deal with sensitive information, so it's very crucial for them to keep the sensitive information of other companies private. And even the accountants that work within an organization such as F&B, it's very crucial for them to keep the financial statements of the company secret, as disclosing it may disadvantage the business. Professional competence and due care. Oblige professional accountants to adhere to relevant rules, regulations, and standards, and in addition to ongoing professional improvement. This is all about adhering to the laws that govern the accountants, and regulations that govern our accountants, and actually investing in the accountant knowledge and skills, like going on programs that improve their knowledge, or taking short courses that improve their knowledge, so that they can provide exceptional services to their client. Basically, this is all about accountants being pressured to misrepresent the financial statements so as they may look appealing, so that they may attract investors into the business. And this behavior is caused by pressures from senior management, such as CEOs or chief financial officers. And this activity of accountant misinterpreting the financial statements, it violates the principle of objectivity, because accountants, they cannot act independently. They cannot use their own judgment and apply the skills and knowledge of accounting when dealing with the financial reporting or any other activity of accounting.
Familiarity threat. This arises whereby the close relationship that the accountant has with a client or a colleague causes the accountant to be excessively trusting or indulgent. So this basically means whereby, because the accountant is close to the colleague or to the client, it will lead to them ignoring the financial irregularities that they may see as they are going through the financial statements.
Self-review threat occurs when an accountant must review their previous or current work, making it difficult to be objective about errors that may be in the work. For example, an accountant prepares financial statements for their own company and chooses to audit them. Objectivity and detection of errors are at risk because they may overlook some flaws in their own models, leading to preparation of financial statements that are not only inaccurate but are falsified and full of errors.
So now I'm going to be talking about the ethical conflict. So what is an ethical conflict? An ethical conflict, it refers to a circumstance whereby the professional accountant is faced with a situation that forces them to undermine the fundamental professional ethical principles of that particular profession, which in this case is an accounting profession. So we are going to be exploring now a deeper scenario whereby there is an ethical conflict, a real life scenario. So pressure to manipulate financial information. Research on ethical challenges in the profession, it has shown that there's the increasing pressure globally, even including in Africa, for the accountant to act irregularly in a way that is not allowed within the accounting profession. And this pressure is being caused by the leadership. The leadership caused the accountants to have this type of pressures, and as well the cultural issues within the organization will also make the clients to behave in that particular way. So the ethical conflict that exists here is that management pressures the accountants to adjust the financial statements, to hide losses, or to inflate performance metrics. And this, it goes against the principles of objectivity and independence that the accountant are supposed to abide by. Moving on now to the behavioral theory, which help us to understand why the conflict exists within the accountants when they face the pressures of acting unethically. And in this scenario, we'll be looking at the social pressure theory, which states that naturally people, they want to behave in a way that maintains the group acceptance and avoid conflict. And this explains why the accountant hesitate when they consider going against the leadership instructions. So this social pressure, it intensifies the ethical conflict within the accountant, which make it harder for them to behave in a way that is objective and is independent from any external influence.
Next, we will be talking about mitigation strategies and safeguards. Fraud mitigation strategies are actions that are intended at detecting and developing actions for a business to mitigate probable and concrete cases of corporate fraud. These actions include precautionary, counteractive, directive, as well as detective control measures. The first threat that we'll be looking at is the intimidation threat. Its mitigation strategy is to establish a confidential whistleblowing channel. By creating an anonymous whistleblowing platform for accountants to report, we provide a safe environment for them to report any errors or falsifying of documents that they may be put under pressure to do. This action is anchored in the theory of deontology, which says that even though accountants have an obligation to their seniors to do their job or to carry out orders as they have been requested, their bigger obligation is to the entity. And in so doing, it is their duty to report financial information which is error-free and 100% true as to their own knowing. One of the sustenance approaches to this would be to regularly publish anonymized reports demonstrating that reports investigated by whistleblowers are actually protected, reinforcing the duty to report is taken seriously by the organization. The next threat that we'll be looking at is the familiarity threat, and one of its mitigation strategies is to enforce segregation of duties. Companies should implement a policy preventing employees from being involved in transactions involving family and friends or anyone who may have any influence over them. These must be counter-cited by an unrelated, neutral third party who is free from bias. This mitigation strategy is anchored in the theory of deontology, which is duty of due care. As professionals, accountants have an ethical duty to exercise due care in their work. Approving a friend or relative's work or transactions may breach this duty. Therefore, it is important that an unrelated, neutral, error-free third party is involved so as to ensure that there is no errors that are being made. One of the sustenance approaches to this would be to conduct regular audits of approval history and publish adherence statistics, reinforcing that segregation is not only for employees but for all. Last but not least, we have the self-review threat. One of the mitigation strategies to this is to mandate independent external review. Strong policies should be implemented that prohibit accountants from reviewing their own work so as to avoid biasness and lack of proper detection of errors. This mitigation strategy is anchored in the utilitarianism theory, which says that an independent review maximizes the overall good by ensuring reliability. This means that in order to ensure that the accountant's work provides the good for all, it is important that their job or the work that they have done is reviewed by
a third party who was free of error and biasness. And the sustenance approach which would be related to this mitigation would be to track and publish the errors found rate by external reviewers versus that of internal reviewers, and demonstrate the greater good achieved through the independent oversight.
To conclude, this presentation examines the significant problem of fraud in the accounting and finance field, stressing how it damages the public trust and credibility of the field. We said accounting fraud is when financial information is deliberately manipulated to give off a false impression of the company's financial position. So this means accountants are first in line in defense of such unethical practices. We used the SEMA Code of Ethics, which discuss the key principles that help accountants uphold moral standards in their job. We identified the common thread showing how this risk can undermine ethical norms and professional judgment if they are not controlled. Establishing private channels for whistleblowers, empowering independent audit committees, ensuring segregation of roles, and implementing scenario-based training are just a few of the strategies to manage fraud. I recommend that organizations should implement regular ethics and awareness to support ethical decision making and professional standards among accountants. Businesses must set up and maintain strong internal controls such as segregation of duties and independent audit committees to detect, stop, and deter fraudulent conduct.